Welcome to another Explainer. Today, we are unpacking a massive and, frankly, truly unprecedented wealth-building opportunity that's unfolding right now in the Japanese real estate market. The whole landscape over there has shifted dramatically, so let's just dive right in.
Right out of the gate, we really have to ask the core question, right? Why is international money suddenly flooding into Japan? After years of these so-called lost decades of economic stagnation, what exactly is the catalyst pulling all these savvy overseas investors toward Japanese property today?
Well, a huge piece of that puzzle lies in a single number: 160. By mid-2024, the Japanese yen hit a historic 34-year low, dropping to 160 yen to the US dollar. Because of this massive currency depreciation, Japanese real estate effectively went on a 40% clearance sale for overseas buyers holding strong foreign currencies. It's this incredible structural discount that we literally haven't seen in decades. So here is our roadmap for today. First, Japan's real estate renaissance. Second, the foreign investor wave. Third, the rise of regional cities. Fourth, the semiconductor property boom. And finally, navigating non-resident financing. Okay. Section 1. Japan's real estate renaissance.
The foundation of this whole renaissance is stark. It's that dramatic depreciation of the yen against the US dollar. And the main catalyst here? The US Federal Reserve aggressively raising its fund rate. This widened the interest rate gap between the US and Japan to a massive 5 percentage points annually. Japan basically became a safe haven, meaning properties went on a massive 40% discount for international investors.
But, it's not just about cheap currency. It's the physical return of people. We're seeing an absolute V-shaped recovery in occupancy rates for business and city hotels. Look, before the pandemic, Japan welcomed over 30 million tourists a year. During COVID, hotel occupancy just plummeted to around 30%, and a lot of places actually went bankrupt. But man, the rebound has been sharp. By early 2024, foreign visitors exceeded 3 million a month. Room rates has skyrocketed. Get this, some 5-star hotels in Tokyo are hitting 150,000 yen per night. That is 50% higher than pre-pandemic levels. The tourism engine is absolutely roaring again. Moving on to Section 2, the foreign investor wave. If we track the chronological evolution of these foreign investors, it reveals a really clear shift over time. It actually started back in the early 2010s with Taiwanese investors who were looking for stable returns when the market was sitting pretty low. Then, by the mid-2010s, thanks to Prime Minister Shinzo Abe's economic reforms, investors from Hong Kong and Singapore flooded in. They were drawn in by solid 4 to 5% rental deals right in central Tokyo. Fast forward to the late 2010s, and mainland Chinese investors joined the fray, expanding way beyond the major cities into vacation hotspots. And finally, now in the post-pandemic era, we're seeing a huge surge of Southeast Asian investors from places like Thailand and the Philippines, stepping up to take advantage of that weak yen. And as the demographics of those investors have shifted, their playbooks have really matured too. The big takeaway here is that while the initial focus was mostly just grabbing single residential apartments for some stable rent, experienced investors are now deploying much more advanced strategies. They're pivoting to higher yield assets. We're talking purchasing entire hotels, running vacation rentals, or even buying up raw land for ground-up development just to capitalize on that massive tourism boom we talked about earlier.
Section 3. Rise of regional cities.
When you look at land price growth, a really fascinating divergence starts to pop up. Tokyo, of course, remains this highly sought-after, incredibly stable baseline. But if you shift your focus over to Osaka, we are seeing explosive, double-digit land price increases. Osaka's Chuo Ward saw an 11.32% increase, and Niche Ward jumped an unbelievable 14.21%. A lot of this is being driven by some really intense optimism surrounding the upcoming 2025 Osaka Expo, plus the planned opening of integrated resort casinos coming in 2030. And honestly, the regional opportunities definitely do not stop at Osaka. Take Fukuoka, for example. It's experiencing a population boom, growing by 130,000 people over 9 years, which is incredibly rare for Japan right now. That's being spurred by massive urban redevelopment projects like the Tenjin Big Bang. Then, way up north in Hokkaido, Chinese and other Asian investors are driving immense demand for luxury vacation properties in the Niseko ski region. Meanwhile, looping back to Osaka, savvy investors are finding massive profitability in something called Minpaku. Basically, they're operating detached houses as short-term vacation rentals, specifically targeting large traveling families and big Asian tourist groups. It's a goldmine.
Section 4. The semiconductor property boom.
To really grasp the frenzy happening right now, just consider this crazy reality. A 3 million yen property increased in value by 30% in just 2 months. Seriously, 2 months. This is happening down in Kumamoto, a region going through a hyper-localized real estate explosion, all tied to the massive new TSMC semiconductor plant. TSMC is, of course, a global chip giant, and their new presence is essentially transforming Kumamoto into a Japanese Silicon Valley. When property values are jumping 30% in just 8 weeks, you know for sure you're looking at a highly unique, localized gold rush.
The crucial thing to understand here is the intense supply and demand imbalance this factory has created. Hotspots sitting directly around the plant, like Ozu Town and Kukyo Town, are facing severe housing shortages. Developers are just scrambling to build high-quality housing for this sudden influx of well-paid tech workers. The demand is so completely off the charts that when new, rare high-end apartments are actually launched in Kumamoto City, they trigger absolute buying frenzies. Investors literally have to enter a lottery just for the right to purchase a unit. No joke.
Section 5. Navigating non-resident financing. So let's start with the good news on the financing front. Japan's market offers some pretty incredible structural advantages. Unlike places like Singapore or parts of Australia, Japan has zero additional taxes or harsh restrictions for foreign buyers. You buy under the exact same conditions as a local Japanese citizen. It's a low-risk, safe haven country. Furthermore, there's a highly attractive yield gap. Properties generally yield 3 to 5% returns, while borrowing interest rates remain incredibly low, typically sitting between just 1 and 4%. But here comes the major hurdle. Traditional Japanese banks are highly conservative. They almost never lend to non-residents. In fact, it's estimated that 90% of individual foreign investors end up just paying in full with cash. Less than 10% actually manage to secure local leverage. To overcome this, non-resident investors usually have to utilize specialized matching platforms, like PropCap, or work with overseas branches of financial institutions based in their home countries just to secure a mortgage. And even when you do find a lender willing to play ball, you have to understand exactly how they view the collateral. Lenders have a very strong preference for residential properties. They view them as low risk, boosting stable income and low tenant turnover. So naturally, bank enthusiasm for residential loans is pretty high. Commercial properties, on the other hand, especially the low-priced ones, they're viewed as much higher risk. They come with high turnover and heavy management costs that can really eat away at your actual returns. If you're looking to utilize leverage to build your portfolio, understanding this lender bias is absolutely crucial. Residential is a much smoother path. And finally, the conclusion. To summarize the journey we just took, the opportunity in Japan right now is undeniable. It's being fueled by a historic low for the yen and a massive, rapid resurgence in global tourism. We're seeing a major strategic shift, with savvy capital expanding way beyond Tokyo to chase explosive growth in regional cities like Osaka, Fukuoka, and Kumamoto. But as an investor, you have to balance this excitement with reality. The challenges include navigating those very strict non-resident financing hurdles we just talked about, and of course, keeping an eye on long-term macro factors, like Japan's overall aging population. Which leaves us with this final thought. The old rulebook for investing in Japan, it's fundamentally changed. With high-growth regional cities stepping into the spotlight and new specialized financing emerging, the market is wider open than it has ever been before. So how will you position your portfolio in Japan's new real estate era? Thanks for joining us for this explainer. And as always, keep learning.